at IAS 37, provisions, contingent liabilities, and contingent assets. So these are the areas we'll be looking at under this standard. We will look at 1, provisions. Under the provision, we will be looking at single and large population, II. We will look at what we call discounting. So we will look at these areas under the provisions. All right, so after that, we will look at 2. We will look at what we call other specific application area. Now, under specific areas, we have what we call future operating losses. I will look at onerous contract. We also look at restructuring provision. 3, we will look at contingent liabilities. We also look at contingent assets. We also have what we call reimbursements. All right, so these are the thematic areas that we will be looking at. So these are the important areas what we will look at under IAS 37. Now that we've cleared that one out of way, let us take it one by one. Then we will look at, or we start talking about it. We will start with what we call provision. Now, under IAS 37, when we say provisions, what does it mean? Or under IAS 37, what does IAS 37 is all about? So IAS 37 has what? 3 key areas that we'll be looking at. We have provisions, we have contingent assets, and we have contingent liabilities. Provisions under IAS 37 is all about a company or an institution what creating a fund or creating a provision against future uncertain timing. What this one means is that as you run an organization, there are certain costs that come to the organization that are not expected. That's what we call uncertain timing. They are what? They are costs that are not expected. And they are costs that are also what? That are expected. So in order to avoid unexpected costs against the company, you should create what we call a provisions against any future expenses that you anticipate because of your past operating events. That is all about provisions. Because right now, assuming you have a school going child who is here to complete his or her basic school. Now, the anticipation is that when the person is going to secondary school, you know that you will have some expenditure to make during that time. You understand? So when that happens, what do you do today? You create a provisional fund against such uncertain timing. You understand? Because it's something that you expect to expend. So for that reason, what do? You have to create a fund so that when that expenses come, you can use the fund that you created to pay off or to meet that obligation. That is simply the provision. So this is what companies usually do so that they cannot be, or they can't find themselves in a situation where they are spending on certain obligation without knowing them. If you recall, we have something that we call provision for bad debt. Why do we create provision against any a debt? In every debt or in every receivables, that you don't know whether you can retrieve or you can receive all the receivable that you've extended to your customers. So for that reason, you have to create. The management may decide that okay, we don't know for certain that we can recover all our 40 million from our debtors. So let us create like 5% provisions against irrecoverable debt from this 40 million. You understand? So this one comes under IFRS 9. It comes under IFRS 9. So when we are creating provision for that bad debt, like 5%, it is usually We call it impairment. So you realize that some part of what debt is what is irrecoverable. So we say that maybe 5% is what is impaired. You understand? So you cannot recover it. So you need to what? You need to create a provision. But you see, this falls under IFRS 9. So with regards to that, all that you have to do is that you have to create what? An impairment against this money. You understand? But we call it provision for bad debt. So you create 5% unexpected debt against the what? Against the money. So that you put it down. So in case you could not, when at the end of the accounting year, if you're unable to what, to recover the debt, then it will go to P&L. If you're able to recover, then you go to P&L at the credit side. It will increase your revenue. Understand? So that is it, or that is the summary of when it comes to what provisions. You have to what, you have to create a provision against what future uncertainties. So that is basically what the explanation to when we come to what the explanation to what to provisions. So we said that according to IAS 37, we said that when a liability of what, of uncertain time, uncertain or what, uncertain or amount, a liability of what, uncertain timing or what, or amount. That's the definition of what, of provision. That's a simple definition of what provision. So with regards to this one, you don't know whether your past event or your activity that you've engaged or what will cost you. You don't know. So if that is the case, then you need to create a provision against that. So as I use your what, your child expected school fees as an example, right? So you need to create a provision against future uncertainty. So if you create that money and at the end of the day, your child is not able to get any other source of income to fund his or her secondary school education, then you have to use the provision that you created to fund it, right? So this is, let me say, this is the idea about it. When you come to IAS 37, it also has what, a laid down principle that you have to what, you have to follow. You have to follow in order to what, in order to meet the threshold. So now that we've removed that one from the way, what is the next? Let us look at what we call recognition criteria. All right. So let us look at what recognition criteria. Before we create provisions in our books or against future uncertain timing, what are the criteria that must met before we can say that, okay, at this point, I think the threshold is met, so we can create a provisions. An institution cannot just wake up and then say that we want to create provisions in our book. No, they have to what? They have to meet a certain condition. You understand? So either your criteria or condition, they are all what? They are all the same. All right. So let us look at the conditions. We have one, present obligation. Before you can say that, okay, the company decides to what, create a provision, they should what? They should be they should be what we call present obligation. Present obligation. When we say present obligation, what do we mean? A present of what we call legal obligation, legal or what we call constructive obligation. First one should what? Should be present as a what? As a result, past what? Event. You understand? So when we say present obligation, it means that the obligation should be legal or it should be what? Constructive as a result of what we call past event. The past event is what? You are an organization that you deal with customers. Anything can happen dealing with during the process of what, of your engagement or your business deal with your customers. Anything can happen. That's what we call present what, obligation as a result of what, past event. Underline the word past event. The past event is what, is when or during the business engagement of your customer. Anything can happen. That is what? That is the past event. What happened? What transpired? Whatever that transpired in the past, what we call past event. So assuming you sell, right? You sell wachi. You are wachi what? You are into wachi business. You understand? You sell. So what do you sell to the what? What do you sell to the customer? So the customer patronize. Customers what? Patronize or customers patronage in the what? In the wachi business is what? It's termed as what? Past events, right? So when they come and what? When they come and what? Buy your what? Buy the wachi. It's what? It's a business what? Arrangement between you, the what? The seller and the what? And the buyer. So it's a past event. So during this business activities, should something happen, it's what? It's an event that had what? That had happened. It's an event that had what? That had happened between you two. That's what we call past events. So this one should certify. Under the present obligation, we have two things that will happen in between the what? In between the customer and the what? And the business owner. We have one, legal obligation. Now, under the legal obligation, assuming and during the period when you were selling the wachi and customers patronized in buying some of the wachi. If a customer or the customers took the wachi and something happened to them, maybe there was food poisoning in the wachi and the person or the customers were hospitalized, they can do what? They can sue. Sued for what? Food poisoning, right? Sued for what? Food poisoning. And what? And expect compensation. This is what we call legal obligation. So you are sued because the food that they bought from you, that's what there's a food poisoning. It forms under legal obligation. So you see, that's why I say present obligation. The present obligation is because of the past event, right? Because of the past event is what? Is the business transaction that happened between the two of you. That is what past event. And then out of that, we have what? Legal obligation and we have what? Constructive obligation. So I've already explained legal obligation. Now let's look at what? The constructive obligation. Now, under the constructive obligation, you the what? You the one who is selling the wachi, right? You the one who is selling the wachi. You have decided to say that, okay, you have decided to give the what? Give the customers what we call, you've given them a warranty usually. Usually if it is what is a physical product, we say warranty. So since it's a what? It's a food that you are selling, maybe warranty, or maybe you're giving them a certain promise, and this promise you've what, which is what, pasted in front of the what, of the shop, that whoever is not satisfied with the what, with the food should return it for refund. Now into bracket, given to its customers over the years, and what, and honor and honors it. Okay. So here now the second one, constructive obligation. This one comes from what? From the business owner itself. So here it is what? It is a condition, or it is what? It's a promise that the business owner publish to the what? To the customers that, okay, our food, if you eat and you have problem, return it and what? We will refund it. This is what we call constructive obligation. And this constructive obligation should be an event, or it should be a promise that the company had already done before and the company honors it. So it shouldn't be a one-off kind of promise. It should be a usual what? Promise the company gives to its customers. So when that happens, we call it what? Constructive obligation. The legal obligation is when the affected customer themselves would sue the company. That's what we call legal obligation. Constructive obligation is where the company itself what? make a decision on what, on each product, that whoever buys it and the person finds problem with it, the person can return it for what, for a refund. We call it what, constructive obligation. So that is the first criteria or condition that must met before we can what, we can create a provision. So put that back on. One is what, present obligation. Another present, or we have what, a present of legal or constructive obligation as a result of past events. All right. Now the elements in them, I've already explained them. So the elements are legal obligation and what, constructive obligation. All right. So let's look at the second one. It's about what, probable outflow. So under the probable outflow, it means that it is more what, more likely than what, than not, which is what, it should be what, it should be more than what, 50% than what, that an outflow of economic benefit will be required to settle the obligation. All right. So with regards to the second one, probable outflow. Now we've already spoken at the first one. The first one is present obligation. The second one is probable outflow. What this one means is that the first one should satisfy, you tick. Second one should also come in, which is what, it is more likely than not. Into brackets, it should be more than 50% that an outflow of economic benefit will be required to settle the obligation. So what this one means here is that if maybe there's a legal, if maybe you have what, Kofi Limited is sued 40 million. The lawyer of Kofi Limited advised that the probable of losing the case is 60%. You see, here the probable outflow of what, of money, or when you are sued, the probability that you lose the case is more than 50%. It means you can what, you can create a provision before, because it met the what, it met the criteria. You understand? Because the probable outflow should be more than what, should be more than what, 50%. That is the mean of what, of the second condition. All right. So the third condition. So if the probability of losing the case is 60%, it has what, it has made the threshold. So you cannot. So the last one is what, reliable estimate. Now, when we say reliable estimate, is what, the amount can be what, can be measured or what, or made. So with regards to this one, if it is constructive or legal obligation, the amount involved should be what, can be measured. You understand? So if the amount cannot be measured, you can't create a provision. So assuming like maybe you are sued for 40 million, right? So here you can see that the amount of what, of the suit is what, is 40 million, which means it can what, measure. So if it's a suit that there's no figure amount there, then you cannot reliably what, measure it into what, to a financial value. So when that happens, then it makes the what, the reliability what, condition. You understand? So these are the three conditions that must met before a provision can what, can be recognized. All right. So note here, all the three conditions what, must met before you can what, you can create a provision. Right. So if any of the what, of the three, if any of the three conditions is not met, no provision is what, is created. So all the three conditions must met, right? All the three conditions must met before you can what, you can recognize what, provision. So if present obligation is met and then probable outflow is not met, you can't create. If present obligation is there and there is a probable obligation to also there, a reliable estimate is not there, you can't. So all the three conditions what must met before you can what, you can create provision, right? So that is what I want you to know under provisions. Scenario A, Brimpon Limited is sued for patent infringement. Legal counsel advises there is 70% chance the company will lose and pay 500,000, right? So is there obligation for that reason provision created?
Yes, sir. Sir, from the statement, we have present obligation. We know patent infringement. That is the one. That is a present obligation.
Yeah.
Then we talk about the probable outflow. We have been told that a percentage of 70% of whatever has happened will always go. And then we saw in the statement that there is a reliable estimate of 500,000.
Okay. And then what about the 70%?
That is what I said. That is a
Okay.
probable outflow.
So you've answered the question. So you have what? The company name is what?
Obrimpong.
So you have Obrimpon Limited. All right. So you have Obrimpon Limited. So it says that. So you ask yourself, so before you do, you will list one whether there's a present obligation. Well, you said there's a present obligation because there's a legal obligation attached. So there's a legal obligation attached, which is what the suit. Okay, two. Is there probable outflow? Is there probable outflow? Yes, because in the question there's what there is more than what 50% what chance of losing the case, where it is what the question is 70%. And then three, is there reliable estimation? So it should be measured. The amount can be measured. Yeah, the amount can measure it. So in the question, you realize that it is what? It is 500,000. So clearly, it met all the conditions. So you say that since the suit met all the met all the three conditions, provision must be must be recognized. So here, what is the provision? The provision is what? The provision is what? 500,000. Have you seen that? So you can decide to do your journal entry here. So your journal entry, you say that you have what? You have your debit, you have your debit, and you have your credit. So you will have what? So you do what? You will have a what? Your provision into bracket P and what? And L, profit and loss account. To bracket profit and loss account. You can hear your provision, credit or what your statement of what financial what position for 500,000. All right. So this is how the entry is what is done. So that is it about the provisions. Okay. So let us advance our conversation from the provisions. Let us look at from provision we've already talked about. So we have under the provision we have what we call single and large population. Now, when you look at single and large population, the example of Obrimpon Limited. Obrimpon Limited falls under what we call single population, right? Obrimpon Limited issue falls under what single population. It means the event is around only what single item. So if a company, so if it is single, for example, you have single population, Ama Limited sold 5,000 each, and the company based on history made a provision of 5% of goods return or goods returns. That's what I call single population. Single. So here it will not, you have to make, you will make what provision of what 5% times what 5,000 goods that you want to sell. You understand? So what, how much is it? So 5% of 5,000 is how much? Okay. So that gives you 250. You see, so if unit price 2,000, you multiply, what do you have? You have what, 500,000. So you will create what provision for this 500. So this is what you call single what population. The single population and what and large population falls under what we call constructive obligation. When you look at Obrimpon, you see that it's what? It's a legal issue. So this Obrimpon falls under what? Under legal what? Obligation. So you take note of that. When you look at the what? When you look at the large and then single and large population, this one, the company is what? The company is promising or giving a warranty that the likelihood of what people returning the goods back is what is 5%. So he has to create a provision towards that so that when these people return the goods back, either they do refund or they change the goods for them. So here it is what it is a practice. You see, constructive obligation is a practice, and before they do this, before they do constructive obligation, things should happen. Either one, under constructive obligation, the company should do one, broadcast the warranty, or maybe place it at the what at the front of the what of the company. Because why? If you don't do this thing, you cannot do constructive obligation. If you don't do what I have just written here, if you don't broadcast it or made it known to the public or the customers, you cannot create provision under constructive obligation, right? Because company can hide behind constructive obligation to avoid taxes. Because the moment a company creates a provision, it affects your P&L. So when it affects your P&L, it reduces your tax liability. It needs so if you do that and you don't broadcast, if somebody bought the good from you and the person is affected, the person may not bring the goods back or return it because probably it is not refundable after you purchase the goods. But if you broadcast it, people can return the goods or aware of the warranty. After a year or two, they can return the goods back to the company so that the company can repair it at the cost of the company. You understand? So once you are creating a warranty, it should be publicized for the people to know. But if you decide to create a provision and you don't make the populace know, it doesn't qualify as a provision. It should be broadcasted. All right. So that's about that. Now let's look at this example. Asante Electronics sells 10,000 products. Based on history, 80% have no defect. Cost is zero. 15% have minor defect. Unit cost is 50 cedis. 5% have major defect. Cost is what? 300 cedis per unit. Scale to what? Scale to population. So this is what you call what? The population. Have you seen the provision that they are creating? They are creating three. So this is what we call the population. You understand? This is what we call population. So what is the expected value of provision the company can create into their books? So this is what we call constructive what obligation. So they have created these provisions so that when the people return the goods back because of defect, the company can repair or change it for them. You see, so if you've made this one known to the customers, we call this constructive obligation. So when they return it, you have to change or repair it for them. All right. So this is what large population. The company name is what? All right. So the company name is what? Asante Electronics. All right. So out of it, they said that based on history, so goods sold, the total goods sold is what is 10,000. Based on history, this is what the provision that they've created. That's the provision that they created. One is what 80% no defect, no defect, and there's a unit price, unit cost is what is 0 series. And the second one is what? Is 15%. And they said have what? Have minor defect. That's minor defect. And the unit cost is how much? 50. And then the last one is what? The last one is 5%. Have major defects. And it has what? Unit cost will be how much? 300. So this is the question. So how do you create provision from this population? You can use what? Two methods what to get whatever you are looking for. You can use two methods. So method one. So let us say method one, you will pick 80% of probability. So here you can call this one is what probability, right? Probability of this one occurring. So you have what? Probability. You have what? What? Unit cost here. So you have what? 80%. And it's a unit cost is 0. So when you multiply, here will give you what? It will give you, this multiplier will give you 0. 2. You have 15% of it occurring. As a unit cost is what? 50 cities. So when you multiply, what do you have? It gives you 7.5. And the last one is what? 5%. And as a unit cost is what? 300. So when you multiply, what do you have? You get 15. Okay. So when you add it, or what do you have? What? 22 and what in price. All right. So how much good did they sell? So this is the what unit cost. This is the total cost of what of provision. So this is what the total expected cost of provision cost. And you say the total goods sold goods is how much? It's 10,000. Then you multiply by what? By cost total cost, which is what? 2.5. So when you multiply, what do you have? 5,000. So this becomes your what? Your provision. You create this provision in your books with expectation that maybe 15% people will return their goods, and it will cost us what? 7.5. 5% will return their goods, and it will cost them for 15 cities per unit. All right. And method two. So when you multiply, so this is what you create in your books. So when you come to method two, you will have your probability and then the product. So you have your first one is what? Is 80, right? You will have your 80%. And the total product that they are selling is how much? The total product that they said they was the question says that 80% have no defect. All right. So if 80% has no defect, then that means 20% what will be defective. Is that not the case? We are interested in what the probable cause. So if 80% will have no, then that means 20% what will be defective. And they said that the total product is for 10,000 units. And then when you multiply, what do you have? That's 10,000. You will have what? Okay, so let me bring the 10,000. Yeah. Okay, so 20%. So you have what? Total number of goods is how much? 10,000. Then your product will be 2,000 here. And they said the unit cost is how much? 0 here. So when you multiply this one by this, that gives you what? Is total cost. That gives you what? 0 here. Now when you pick the two, the second one is what? 15%. Multiply by the total cost of what? Of the total products sold, which is what? Times at 10,000. That gives you 1,500. And they said the unit price is how much? So this one is 1,500. This one is what? 1,500. They say unit price is how much? Unit price is 50. All right. So you multiply that by 50. What do you have? You have 75,000. And the last one is what? 5%. You multiply by 10,000. Okay. What do you have? And unit cost is how much? 300. You have 150,000. I know I don't add them. What do you have? You have what? 2 2. So this becomes your provision that you take to you take to your statement of financial position and your your P&L. So you do your journal entry beautifully. So you have your debit and you have your credit. Okay. So you provision, I go P&L. That is what 2 2, and then you have what you have your provision. I go to a statement of financial position, which is what 2 2. All right. So that is it about that.